Here's what you need to understand about February's Social Security payments. And I'm going to give it to you straight, the way I've always approached problems, by looking at the facts without the nonsense. February's SSI benefits will be paid to recipients on Friday, January 30th, because February 1st falls on a Sunday this year. Now, this isn't some magical extra payment, though I've seen people get confused about this. It's simply how the system works when calendar dates land on weekends. The Social Security Administration shifts payments to the preceding business day to ensure you have access to your funds when you need them. Social Security and supplemental security income benefits for 75 million Americans will increase 2.8% in 2026. For the average retiree, this translates to approximately $56 more per month. The average retirement benefit has risen to about $2,071. Now, is that enough to keep up with your actual expenses? That's a question you need to answer for yourself, but at least you know the numbers. Here's what matters for your planning. If you receive SSI, you got your January payment on December 31st because New Year's Day was a federal holiday. Your February payment arrives January 30th. Then your March payment comes February 27th because March 1st also falls on a Sunday. This creates what looks like two payments in January, but it's not extra money. It's just early delivery. Budget accordingly, or you'll find yourself short later. For regular Social Security, retirement, and disability benefits, payments follow your birthday. Second Wednesday if you were born between the 1st and 10th, third Wednesday for the 11th through 20th, and fourth Wednesday if you were born after the 20th. Those who started receiving benefits before May 1997 get paid on the 3rd of each month. The government shutdown concerns, your payments continue. Social Security is mandatory spending, not subject to these disruptions. That's one less thing to worry about. Now let me explain something about this 2.8% increase that requires a bit more intellectual honesty than you'll typically find in these discussions. The Consumer Price Index for urban wage earners and clerical workers determines this adjustment, and there's been considerable debate about whether this particular index actually reflects the spending patterns of retirees. I've spent my life studying human behavior and incentive systems, and one thing I've learned is that when you measure the wrong thing, you get the wrong result. The CPIW tracks spending habits of wage earners, not retirees. Seniors typically spend a disproportionate amount of their income on healthcare and housing costs that often rise faster than general inflation. So you're getting an adjustment based on how working people spend money, not how you actually spend money. That's not ideal, but it's what we have, so you need to understand it and plan accordingly. Let's talk about what this actually means in dollars and cents, because that's where theory meets reality. The maximum federal SSI monthly payment for individuals will increase from $967 to $994. For couples, the maximum goes from $1,450 to $1,491. For those on Social Security disability insurance, the average benefit rises from about $1,586 to $1,630. These aren't life-changing amounts, but they matter when you're living on fixed income. Here's where the situation gets more complicated, and this is something you absolutely must understand if you're going to manage your finances properly. The standard Medicare Part B premium increased to $202.90 per month in 2026, up from $185 in 2025. That's an increase of $17.90, or nearly 10%. Now, for most of you, this premium gets automatically deducted from your Social Security check. So while you're getting $56 more on average from the COLA, nearly $18 of that immediately disappears to cover Medicare Part B. You're left with roughly $38 extra per month. That's better than nothing, but it's not the full $56 you might have been expecting. This pattern has been repeating itself, and it's worth noting because it affects your long-term planning. This marks the third straight year that the Medicare Part B standard premium has risen faster than Social Security's COLA. The premium increase of nearly 10% was more than 3 times the 2.8% COLA. When costs rise faster than your income adjustments year after year, you're falling behind in real terms. This is basic mathematics, not opinion. If your medical insurance goes up 10% and your income goes up 3%, the gap between what you need and what you have widens. Understanding this helps you make better decisions about your spending and saving. There's a concept called the hold harmless provision that some of you might benefit from, though most won't. This provision prevents Medicare Part B premium increases from reducing your monthly Social Security benefit below what you received the previous year. But this only applies if your premium is deducted from your Social Security payment, and it only protects those with relatively small benefits. If you're receiving benefits well above the average, this provision doesn't help you. The law was designed to protect the most vulnerable, not to shield everyone from premium increases. That's a policy choice, and whether you agree with it or not, you need to know where you stand. Now let's address the payment schedule in detail, because confusion about when money arrives causes unnecessary stress, and stress is something you want to minimize in retirement. For regular Social Security, retirement, and disability benefits, the system works like clockwork based on your birthday. If you were born between the 1st and 10th of the month, you receive your payment on the 2nd Wednesday. If you were born between the 11th and 20th, you receive it on the 3rd Wednesday. If you were born after the 20th, you receive it on the 4th Wednesday. In February, that means February 11th, 18th, or 25th, depending on your birth date. Here's where it gets a bit more intricate, and paying attention to these details can save you from worrying unnecessarily. If you began receiving Social Security benefits before May 1997, you're grandfathered into the old payment system. You receive your payment on the 3rd of each month, or the preceding business day if the 3rd falls on a weekend or holiday. If you live outside the United States, or if you receive both Social Security and SSI, or if your state pays your Medicare premiums, you also get paid on the 3rd. These exceptions exist for valid administrative reasons, but they mean you need to know which category you fall into. For supplemental security income recipients, the pattern is different and requires careful attention this month and next. SSI payments typically go out on the 1st of each month. But here's what's happening in these first few months of 2026 that's causing some confusion. Because February 1st falls on a Sunday, the February SSI payment was issued on Friday, January 30th. That's not an extra payment. It's simply early delivery because the government doesn't process payments on weekends. Then, because March 1st also falls on a Sunday, your March SSI payment arrives on Friday, February 27th. This creates a situation where you receive what looks like 2 payments in January, then no payment during most of February, then another payment at the end of February that's actually for March. This kind of calendar quirk happens periodically, and if you don't understand what's going on, it can throw off your entire budgeting system. I've always believed that understanding the mechanics of any system helps you work within it more effectively. If you receive SSI and you spend your January 30th payment thinking you'll get another one in early February, you're going to find yourself short of funds. The money coming on February 27th needs to last you through March. This requires discipline. You need to budget these payments carefully, spreading each one across the full month it's intended to cover. Let me address something else that's been on people's minds, particularly given the political climate. Government shutdowns and federal funding debates can create anxiety about whether your payments will continue. Social Security payments continue during government shutdowns with no change in payment dates. This is because Social Security is mandatory spending, not discretionary spending subject to annual appropriations. The distinction matters enormously. Mandatory spending continues regardless of whether Congress passes funding bills. Your benefits are protected by this structure. However, some Social Security Administration services might be reduced during a shutdown. In-person offices remain open, but their ability to process certain requests like appeals or replacement Social Security cards could be limited. Knowing this helps you plan. If you need to handle administrative tasks with Social Security, don't wait until the last minute. Now there's a new development that affects some of you, and it's important enough that I want to explain it carefully. There's discussion of a temporary senior deduction that would reduce the taxes many of you pay on Social Security benefits through 2028. The details are still being worked out, but here's what you need to understand about Social Security taxation in general. Depending on your income level, you might pay federal income taxes on your Social Security benefits. This isn't new. The taxation of Social Security benefits has been part of the system for decades. The revenue from these taxes goes back into the Social Security trust funds. Any change to this taxation affects the long-term solvency of the program. According to the chief actuary's analysis, this proposed deduction would cost the program substantial revenue and could accelerate trust fund depletion by several months. I'm not telling you this to advocate for or against any particular policy. I'm telling you because you need to understand the trade-offs. Lower taxes now might mean more pressure on the system later. That's not a value judgment, it's arithmetic. Let's talk about something practical that affects those of you who are still working while receiving benefits. The earnings limit for workers younger than full retirement age will increase to $24,480 in 2026. If you earn more than that, Social Security deducts $1 from your benefits for each $2 you earn over the limit. For people reaching full retirement age in 2026, the limit is $65,160 and the penalty is more favorable. $1 deducted for each $3 over the limit. Once you reach full retirement age, you can earn as much as you want without any reduction in benefits. These earnings tests confuse people, but they're straightforward once you understand them. If you're planning to work, you need to estimate your earnings and report them to Social Security. If you don't report and you earn too much, you'll be overpaid, and you'll have to pay that money back. The system isn't trying to trick you. It's trying to ensure that people who are still earning substantial wages don't collect full benefits designed for those who've stopped working. The maximum amount of earnings subject to Social Security tax is also changing. In 2026, you'll pay Social Security tax on work income up to $184,500. This is up from $176,100 in 2025. If you're still working and earning above this threshold, this affects you. If you're retired and not working, it doesn't. But it's worth understanding because it affects the overall funding of the system you're depending on. The Social Security tax rate itself isn't changing. It remains 6.2% for employees, with employers paying another 6.2%. Self-employed individuals pay the full 12.4%. These taxes fund the system that pays your benefits. Here's something I want to emphasize about the overall structure of Social Security that doesn't get enough attention in these discussions. The system has been operating for decades, and it has built up substantial trust fund reserves. However, those reserves are projected to be depleted within the next decade or so if no changes are made. Once the trust funds are exhausted, incoming tax revenue would cover only about 70 to 80% of scheduled benefits. This is a long-term structural issue that requires legislative solutions. I mention this not to alarm you, but because understanding the context helps you make informed decisions. Your benefits aren't disappearing tomorrow, but the system faces challenges that will need to be addressed, and those solutions might affect future benefit levels, taxation, or retirement ages. Staying informed about these discussions helps you advocate for policies that serve your interests and plan for various scenarios. Let me also address the Medicare Part B deductible because this affects your out-of-pocket costs. The Medicare Part B deductible is $283 in 2026, up from $257 in 2025. This is the amount you pay out of pocket before Medicare starts covering costs. If you have supplemental insurance, it might cover this deductible. If you don't, you need to budget for it. Healthcare costs represent one of the largest expenses for retirees, and these incremental increases add up over time. The Part A deductible, which applies if you're admitted to the hospital, increased to $1,736. These aren't trivial amounts, and planning for them is essential. The key to managing all of this successfully is having a clear-eyed view of your actual financial situation. Calculate your real net benefit after all deductions. Don't just focus on the gross COLA increase. Look at what actually hits your bank account after Medicare premiums are deducted. Track your spending to understand where your money goes. Health care, housing, food, utilities, these core expenses need to be covered first. Everything else is discretionary. If your benefits aren't keeping up with your expenses, you have limited options. Reduce expenses, find additional income, or draw down savings. None of these options are pleasant to contemplate, but understanding your situation clearly is the first step to managing it effectively. One more piece of practical advice. Make sure you have a My Social Security account set up online. This gives you secure access to your benefit information, payment history, and official notices. You can see your COLA notice online rather than waiting for it to arrive by mail. You can set up text or email alerts for new messages. You can update your direct deposit information. These online tools exist to make your life easier, but they only help if you actually use them. If you're not comfortable with computers, ask a trusted family member or friend to help you set this up. Access to accurate information about your own benefits is valuable, and the government has made it available. Take advantage of it.